Hello, clients and friends. This is Robert Scott from Pre-Emptive Financial Services, and it's my pleasure to update you with market and economic information. So today our agenda is quite simple. We have a straightforward agenda dealing with the economic and market update and some guidance that we're suggesting for our clients. Um, we always want to review the important features of financial planning, which are five: preservation, planning, retirement, tax, estate, and investment planning. So we try to do all of these areas because we have to be able to balance your goals along with these different areas. But we want to make the point that today we're going to focus on investment planning. Our firm is partnered with you because we believe our clients are the best when they're educated. So when it comes to your finances, knowledge is power, and our mission is to share knowledge with you so you can make an informed decision. The equity markets in review have been exciting in some areas, to say the least. What a difference a year makes is what this chart is entitled. And if you'll note, the February 19th was where the market went over the precipice. It was at an all-time high, and then it dropped about 33% to the bottom in March. And that was because of COVID. It was where COVID was taking off, and there wasn't any real good things in the future, and the way the news was presenting it. But for those who didn't panic, if they just sat tight, uh, by August 18th, you had recovered completely. Many of the investments we chose with the managers were back to even much more timely than that. But the point is that market averages. So the S&P 500 equaled out by August. So we had a bad dip, but it didn't last that long. So let's see what's going to happen now. April, we're at new highs, and now May is ending that way as well. So volatility hasn't gone away, but the market continues to plow forward. Interest rates are a very big, important issue because the Fed is adjusting interest rates as they see market conditions. We are currently at a almost zero interest rate. So this deeply affects the investments that are available in the banking world. The Fed does not anticipate any substantial rate increases. They want to see progress toward more employment, and they want to control inflation. So this is what safety is costing. So if you'll note in the screen there, the fund rates from the Fed are at 7 basis points. A year ago, they were 8. But look at the bank money markets. A year ago, they were 16. Now they're 7 basis points. 12-month CDs on the average. This is from Barron's. A year ago, they were 0.46. Today, they're 0.18. So if you invested your money at 0.18% without taking into taxes, any consideration for taxes, your money would double in a very short time, 350 years. So that's not a very good approach to reaching our goals. Therefore, equities have to be a part of our diversified portfolio. We've seen some very important things, though, through this time. So what we want to bring out, the media magnification. They just make such a big story out of every piece of bad news. They're sensational. It can overwhelm us, can stress us, can confuse us. So our objective is to help you create and follow a strategic plan with realistic goals. Veering off course in hopes of short-term gains could compromise our financial future and our long-term goals. So please, if you have any questions, get back to us. We don't want you to make any sudden moves until we talk. But paramount, your personal health is paramount. So remember, stress doesn't help. So let's do our best to stay healthy. Here's a chart that shows time horizon. This is an essential factor in selecting our investments. If our money is short term, that means it's there for use in 2 years or less. Medium is 2 to 10 years when we would use the money, and long term is 10 years plus. We want to match our investments to these time horizons. This is essential so that we keep the big picture in mind. We don't want to be distracted from our long-term goals. We want to avoid making impulsive decisions short-term, particularly in our medium and long-term accounts. Here's risk appetite, another key factor. How do you manage risk? I like to say, how do you sleep at night? We can control our risk, and we can also make it so that we um, dial it up and down. So we can do that. The amount of risk that you accept is a big factor. So we have brought out we can control risk. We can control our goals with when the money is used, time horizon. We also have to control our behavior. So as the picture shows here, the thing we can't control is our return. So that's what investors so often focus on. And we may have a down return when we've got everything else right. Well, what does that mean in 6 months? What does that mean in a year? So that's the type of thing that we look at, control what we can, and what we can't, let's examine analytically. So this shows you the risk return. The higher the risk we take, the higher the potential reward. The lower risk, lower potential reward. So we want to put our investments in a time horizon and a risk appetite that's appropriate. So the higher the risk means the longer the time horizon. So we match it to that. Long term is the way most of us should think as investors, because then we're successful and we act like the long term. We can't predict market movements, but we can prepare. So how do we prepare? Um, we watch market volatility. We watch the downturns. We watch the upturns. We can invest confidently when we know what our goal is and we match all the factors that we can control. Even though people are concerned that equity markets are at a high, we also want to proceed with caution because we don't want to be involved in something high risk, high reward, and the market turns down if that's a short-term goal. If it's a long-term goal, that's a different story. We're okay with that if it's long-term. So be prepared so that we can control our emotions. There's another issue. Mr. Biden has said that he is recommending changes to tax law, and these will affect tax rates. He wants to increase the taxes on the wealthy and increase the taxes on companies. So we'll keep you updated with news on that and how we can adjust. But right now, those laws haven't gone into effect. So what can we do now? We had a change in 2021, I should say for 2020, and that affects our planning for 2021. The Secure Act changed the way IRAs are treated. So it used to be that IRAs could be given to children and they would pay out over their lifetime. That rule changed. So you can give it to your spouse and it acts just the way yours does. So there's no change with that primary beneficiary. But if it goes to children, they have 5 years to distribute it. It changes our strategy. So we have to look at those things very carefully. Here's another thing that's on the horizon. This hasn't happened yet, but as shown in the illustration there, Senator Sanders is proposing an increase in the estate tax rate. Currently, each spouse gets $11.7 million unaffected by the estate tax rules. But Mr. Sanders wants to reduce that to $3.5 million. And then the tax rate will go up on that money. So if we're worth $7 million as a married couple, any money over that will be taxed at 45% estate tax. Doesn't affect us while we're alive, it affects our children. Well, how do we plan that? We look at that and we go, okay, here's a strategy. So as these rules change, the strategies will come forward and we'll inform you of them. So key takeaways for today. Despite continued volatility, equity markets are doing okay. We're on a high note. We don't anticipate a huge change from that because people are going back to work. We expect interest rates to continue low through 2023. The economic recovery is largely based on vaccine distribution and reduction of COVID-19 cases, and the new administration is bringing changes to tax laws and other matters. So we have to be mindful, watchful. So that's why caution and vigilance is important. Don't get distracted from your goals because of a news report or some other little thing. Focus. Make sure your time horizon for that investment matches your risk, and be careful with your behavior. So call us with any concerns. We're here to help. Charlie Munger is Warren Buffett's business partner, and he makes a very wise remark here. It's waiting that helps you as an investor, long term, and a lot of people just can't stand to wait. And we know that's how people feel. Don't give in to that emotion. So what can you expect from me? Regular reviews of the changes, market conditions, tax laws, policy changes. You'll get regular communication from me and more frequent discussions on these matters. This will aid us to control the things we can control. We'll review economic, tax, estate, and investment issues individually because all of you are custom for your circumstance. We want you to know how much we appreciate you, and we do appreciate when you share our name with others. So we want you to know that if you add 2 names to our list, you're invited to a very special event that we're having in January. And we hope this year we can have it in person. So we appreciate you. We are thankful for everything that you do for us. And we want you to know our focus is assisting you with your financial matters. Remember, your health and well-being is the highest of our priorities. Your health matters. So keep that first, and then the financial matters, we'll do our best to keep them apprised to work for you. So thank you for paying attention. Here's the little verbal verbiage for the program, but I think we appreciate your attention, and we ask that you enjoy the rest of your day.